Oh, what's up, everybody? It's Matthew Mickey here, and boy, do I have a good one for you today. So today we're going to be talking about quantitative easing and where it comes from, when it started, and how it happens. But before we do that, I want to bring up one point. So I read an article by Silvia Amurva, which was written in December 2012, called "The Merchants of Wall Street," and she talks about investment banks involving the purchasing of commercial banks in physical commodities, not just financial assets. Right? She testifies in front of Congress about the financial crisis leading these commercial banks, the bank holding companies, which before this was an absolute no-go. Why? Activity restrictions from federal law. They would have never before this time wanted to be subject to bank holding companies laws, which lead to like low leverage ratios and stuff like that. So the financial crisis hits, and JP Morgan and the other banks go begging to the Fed Reserve to bail them out and give them bank holding company status. Now let's talk about quantitative easing and how it happens and incorporate these bank holding companies now that have an account with the Fed Reserve. So we have central banks that issue money through digital IOUs. We're not focusing on physical cash here. And they issue these digital IOUs to commercial banks called reserves. And the commercial banks then use those reserves as money through digital IOUs in the form of loans to non-bank, such as us, companies, non-bank holding companies, such as pension funds, insurance companies, credit unions, and such, right? So right here, we can see we have the Fed Reserve. And for teaching purposes, I want to focus on one non-bank commercial bank and their one account with the Fed here. Okay, so the Federal Reserve Bank has assets and liabilities, and in this case, the account held by the commercial bank has, we'll say, $400 billion of reserves in the accounts from the Fed Reserve, which owes to the commercial banks. Now, the commercial banks has its own assets and liabilities, and in this case, let's focus on the $400 billion assets of reserves in the account. Now, the liabilities we'll focus on for this example is held by the investment service, turning your 401k into retirement one trade at a time, and it has an account with assets of $300 million in it. Okay, and now we're talking about the balance sheet of the investment service. So this investment service has $500 million of U.S. Treasuries of assets of $400 million in mortgage-backed securities, and let's say $200 million more of U.S. Treasuries, right? And then they have that $300 million within that bank account, totaling $1.4 billion worth of assets, right? So now we need $1.4 billion worth of liabilities. Let's say they have $600 million of pension, and that big of a pension will bring them pressure to bring money into the account, right? They have a liability of $300 million, and then they have a liability of $500 million in equities, which is a good thing. Why? Equity holders of this investment service are owed this much equity. So basically, the investment service owes the shareholders this equity. So now let's talk. A crisis happens, and at the end of this video, I'll show this live using COVID-19. Anyway, a crisis happens, requiring the Fed Reserve to, get money into the higher yielding assets. For example, the Fed Reserve sees that the investment service has 500 million U.S. Treasury assets, and they say, I bet those pension funds in the investment service are putting a lot of pressure on them. I wonder if they want to trade those treasuries, which earn a low interest, for something more high yielding to cover the payout from the pensions. So the Fed goes directly to the investment service and says, hey, we will give you $500 million of reserves that we created out of thin air for your $500 million U.S. Treasuries. And you can take that $500 million and invest it in a higher yielding asset. Well, the investment service is like, no, that's monopoly money to us. Like, we don't have an account with you. The Fed says, watch this. We'll order your commercial bank to create a $500 million loan and put it in your account. So go on and give us those $500 million treasuries, and we will take those reserves and we will stick them in your commercial bank account with us. And those, the $500 million in reserve creations and deposited into the commercial bank's account with the Fed is the master QE system. Now watch this problem is that the commercial bank is up $500 assets, and the Fed Reserve Bank and the investment service is down 500 million assets from the 500 treasuries. So the Fed Reserve tells the commercial bank to put a 500 million IOU in the bank account of the investment services they hold with them. And we already know that from the last video, the commercial bank will make a loan and do that. And all assets and liabilities in all three will be balanced out. And now the investment service might say, my research says Tesla might be a good replacement, and they'll take that 500 million and invested in Tesla stocks. And this is how the QE gets turned into bank money, which goes into the stock market. Now we should be able to look at the Fed data in their graphs and see this play out. For every dollar added to the reserves, we should see a dollar in the money supply. So let's head over to the Fed website and see if this plays out, right? Let's pull up the graph of total liabilities for the Fed Reserve, right? Remember the last video, we actually looked at the budget sheet, the balance sheet, and this time we're going to look at the graph, right? We can see the financial crisis here and COVID had a pop on this, right? But before that, before the 08 crisis, what did we notice? We noticed that the reserves were used to cover the transaction fees between commercial banks, right? As they were intended to. All right, so liabilities include federal notes and cash, and in quantitative easing, it's all done through digital footprints, right? So the Fed isn't driving around 18 wheelers worth of cash and doing this process. So let's go to edit graph, type in currency in circulation, and change it from billions to trillions and remove it, the physical cash out of this chart. All right, so we can see that during this time, before 08, the reserves were being used for what they were designed to do, and that's settle bank transactions. Then the financial crisis hit, and the Fed started using reserves to bail things out. And there was never really a recovery since then. All right, step 3, COVID happens, and the Fed created reserves before COVID. The Fed created reserves before COVID was 2.33 trillion. Then they added 2.76 trillion from March to June of 2020. And then after, COVID, there was 5.10 trillion worth of reserves, and it continues to increase. Now let's see if this increase in reserves has any effect on the economy. We should be able to see the clone in the economy, so let's look at the M2 money supply. And don't forget to cut out the currency in circulation to discredit all the physical cash. And as we can see, before COVID, there was a national growth rate of the M2 money supply. No QE, then the national growth rate would have continued at a 4.4% for every 4 months as commercial banks expanded. So with no QE in November, the money supply would have been 14.24 trillion with no QE but then COVID happened and QE happened, and in November it's 16.98 trillion with a difference of 2.74 trillion. Compare that to the increase in reserves created out of thin air, the 2.76 trillion. That is a 99.1% difference for a one-for-one reserve to commercial bank money. So where's it going? So let's talk about it, because everybody will tell you that QE has no effect on the economy, but every dollar added, we just saw for QE, has added $1 to the economy. And so let's look at this document wrote by the Central Bank of England. And they wrote this document in 2014 that reads this. Quantitative easing is intended to boost the amount of money in the economy directly by purchasing assets from non-bank financial companies. QE initially increases the amount of bank deposits those companies hold in place of that assets to sell. Those companies will then wish to rebalance their portfolio of assets by buying higher yielding assets, raising the price of those assets and stimulating spending in the economy. Lastly, as a byproduct of QE, new central bank reserves are created out of thin air, but these are not an important part of the transition mechanism. Okay, so the real clone of QE is the reserves, and it's to increase bank money so it can be spent on higher yielding assets like the stock market, right from the horse's mouth. And lastly, I'll leave you with this. As we looked at the deposits at the Fed, I broke them down into 3 phases. Before 08, which was 95 years, when the deposits was used as bookkeeping for the deposit for commercial banks. 2008 to 2020, when the Fed realized they can create money out of thin air by creating reserves to buy assets. And then this is used to bail out banks and never make it to the retail circuits. As we can see, they tapered this in 2018 to the fall of 2019. Now we look at this with retail deposits overlaid onto the Fed deposits, right? Now we can see that the retail did whatever it wanted until 2020, and then we saw a change, right? 2020, the wholesale started having an influence over the retail circuit. Until then, the Fed buying asset had no impact on retail deposits, right? Now, because of 2020, you can see the Fed action starting to control retail. This was caused by a crisis in the repo market in 2019. Commercial banks stopped lending to the repo, all right? And they pulled their money out of the repo market. The Fed started adding money to the repo market. Then they raised interest rates to insist a demand for the repo market. Now, my buddy Bond King on Twitter explains this really good in one of his videos, which I'll link in here. Now, when the Fed started creating reserves in '08, people thought this would cause inflation. But from '08 to 2019, the Fed could add, as we saw, and not have any impact on the retail circuit, so no inflation would happen. The change happened due to the repo inflection moment that happened on September 11th, 2019. All right, and that was at an effect, right? It affected the retail deposit, right? So for 100 years to this point, the Fed adding money has never affected us until it did. On August 22nd, 2019, BlackRock issued a plan saying there would be a turnover, and this is how the Fed needs to fix it. The Fed hires BlackRock to pick assets to buy, but you need to focus on COVID at this point. And here's the plan, right? And if you read into it, there is not enough monetary policy to deal with the next downturn. This is in 2019, and interest rates aren't going to be able to cut it. All right. The Fed has to find a way to get wholesale deposits into the hand of retail private circuits, right? So basically, when they add money to the wholesale circuit, they need to add to the resale circuit as well. Then make a tool to buy equities to cause credit easing. 3 weeks later, QE happens. Then BlackRock said in this plan, this needs to become a permanent thing, not like 2008 when you controlled retail circuits for a blip. So what happens? September 11, 2019, the Fed starts shivering wholesale money into the retail circuits for the first time ever, right? And then 2020 happens, and the Fed hires BlackRock to pick securities for them to purchase. And the next year, $3.5 trillion were added to the wholesale and retail circuit, stock market, and millionaires became billionaires. Then the Fed started talking Fed digital currency, and inflation hits. Stay tuned because my next class is going to be even deeper, and we'll teach you how to apply this into your trading. And then you can decide what you think about all this.